Have you ever wondered how private equity firms can sometimes generate significant cash returns from a company without actually selling it? It is a fascinating financial strategy that allows investors to monetize their stake early, and it is a common practice in the world of private investments. This financial maneuver is known as a dividend recapitalization. Financially, it works by having a company, often one owned by a private equity firm, issue new debt to fund a substantial cash dividend payment to its existing shareholders. Essentially, the company takes on more leverage, and the proceeds from this new borrowing are then distributed to its equity owners. The core financial mechanism behind a dividend recapitalization involves increasing a company's debt burden. Private equity firms typically pursue this strategy when a portfolio company is performing well, demonstrating stable cash flows, and when credit markets offer attractive borrowing terms. By taking on new debt, the company's capital structure shifts, reducing the equity component relative to debt. This allows the private equity owners to effectively extract a portion of their equity investment and realized gains earlier than a full sale, while still retaining ownership and control of the company. The amount of new debt is typically determined by the company's cash flow generation and debt capacity, often benchmarked against its earnings before interest, taxes, depreciation, and amortization, or EBITDA. Executing a dividend recapitalization involves several key steps. First, the private equity owner and the company's management assess the market for new debt, often engaging investment banks to arrange the financing. This new debt can take various forms, such as term loans from banks or high-yield bonds issued to institutional investors. Once the debt is secured and closed, the capital raised is then distributed as a one-time, large cash dividend directly to the private equity fund that owns the company's shares. An important nuance of this strategy is its impact on the private equity fund's internal rate of return, or IRR. By receiving cash earlier in the investment cycle, the IRR can be significantly boosted, making the fund's overall performance appear stronger to its limited partners, or LPs. This strategy allows the private equity firm to de-risk its investment by getting some of its capital back, while still holding the potential for further upside when the company is eventually sold. Ultimately, a dividend recapitalization is a sophisticated financial tool that allows private equity investors to accelerate their returns by leveraging the target company's balance sheet. It strategically optimizes the timing of cash distributions, providing early liquidity to investors and potentially enhancing fund metrics, all while managing the associated increase in the company's financial obligations.